So I think that as we enter a more multipolar world, either because neutral reserve assets are more popular or because there's some degree of diffusion among the top five or so currencies, that actually takes some of the imbalance away from the US economy. And going back to my earlier point, if that's kind of acknowledged to be happening, there are ways to kind of make that transition more graceful than if they try to fight back and fully maintain hegemony, even when it's no longer even serving our interests anymore. So I think that's kind of the big risk there.
Hey guys, welcome to Everyday Finance. Wealth doesn't vanish in an instant. It erodes, slowly, often unnoticed. Every unit of money is tied to a system that keeps expanding, and as it does, your slice of the whole quietly shrinks. Inflation shows the surface damage, but dilution is the real force at work. That's why cash, while safe in the moment, decays in value over time. The same principle cuts across all assets. More issuance means less ownership. Lyn Alden puts it plainly, every asset carries a dilution rate. Real estate might grow by 1 to 2% a year, gold by about 1.5%. Small numbers at first glance, but stretched across decades, they shape your financial destiny. That's why scarcity matters. In a world of endless printing and replication, strength lies in what can't be easily duplicated. Quality businesses, prime land, precious metals, and Bitcoin all endure because they resist dilution. When uncertainty rises, scarcity isn't just a strategy, it's protection.
Over the long arc of time, I think it's worth monitoring. I've been able to talk to some of the experts that focus on this, so they kind of come up with their potential solutions and how they might address it. So just like how USB and Ethernet update over time, Bitcoin does update over time. In terms of non-consensus changes, there's regular updates, and then in terms of consensus changes, there's occasional updates that happen over time if a very large percentage of the network agrees to do it. And potentially they could replace the signature types with more quantum resistant signatures. The downside is they generally take a lot more space. And therefore you run into issues like the block size limit, the amount of bandwidth that is needed. So doing it prematurely is unlikely to be successful because there's going to be more pushback against the cost of that compared to doing it. So I think I'm optimistic that I know that there are solutions on the table. They might be just like how we talked before about the complexities of the fiscal budget, that there are solutions. They're just kind of hard to arrive at. The same is generally true for Bitcoin and quantum resistance, that if we do hit that point, there are solvable ways around it. And then, I still think it'll take many years to probably reach that point. Sure, I would say that for any asset you own, think of the dilution. So if you're owning fiat currency and the currency supply is growing by 7% per year, you're owning a smaller and smaller share of that network. Equities and real estate have different dilution rates. So for example, real estate might have a 1 or 2% long-term dilution rate. Gold has something like a 1.5% long-term dilution rate due to new mining. So for any asset that you consider owning, a first step is to know the dilution rate, both in terms of the number of units, if you can, and also market share. Is it kind of being diluted because it's losing market share in a big thing? So I think the main thing is to own truly scarce things that are then not being diluted. So high quality equities, high quality real estate, precious metals, Bitcoin, whatever kind of how much research they've done, they might be more convicted in certain areas than others. And for Bitcoin, I think my advice tends to be that there's a lot of numbers that make sense, but zero is probably not the right one, which is to say, there are people that are more than 100% all in, like they're levered long. And there are other people that a 3 or 5% allocation could make sense. But I think that if you don't own any, and if you've never sent a Bitcoin transaction, I do think that going forward, that's a good thing to have done. It's a good thing to have, at the very least, you've educated yourself on the functionality of this, basically a different way of doing money. And I do think that going forward, just zero is not the right number. It could be an amount that's not that important to you, but at least you have skin in the game now, and maybe would pay attention to it going forward. I think we're seeing gradual diffusion Because people, when they think about dollar losing status, their immediate thought is what replaces it. And the
Hmm.
answer is that there's no other fiat currency that has the characteristics to replace the dollar. And so, for example, after World War II, the United States was like over 40% of global GDP. We had all the
Whoa.
manufacturing base. Yeah, we had all the gold. We were the only entity still standing, basically. Everything else was rubble. And so you're in this kind of unusually dominant position, and we've been able to ride that now for 80 years. And there's no so the U.S. is no longer in a position that's anywhere near that dominant. We're a quarter of global GDP on a purchasing power basis. We're even less, something like 15%. On a purchasing power parity basis of GDP. But also China's not big enough. Europe's not big enough. There's no other currency block that's really in a position to just be the global ledger that everyone uses. So I think that the challenge on the dollar is not going to be another fiat currency. It's going to be one of two things. It's going to be a more of an interest in neutral assets, so things like gold and Bitcoin. Currently, by far, because gold's 10 times bigger, that's the preference that central banks have been doing over the past decade or so, where they're gradually kind of bringing gold back into the system to some
Mm.
extent. Even some of them were repatriating it because they were like storing it abroad, and some of them were actually paying the expense and logistics of getting it back in their own borders.
Whoa.
And then around the margins, there are some like El Salvador, the Kingdom of Bhutan, that get Bitcoin on their balance sheet, or in certain sovereign wealth funds, they have indirect exposure. So I think that will become more common. And then two, there can be more of a diffusion of currencies where there's no one currency that displaces the dollar. Let's say the Chinese currency goes from a 0% holding to a 5% to a 10% holding, for example, and you get more of this plurality, especially I think that basically that whole kind of the whole region around Asia is probably, I think, going to gradually a little bit get more in China's orbit over time,
Mm.
which I don't necessarily view as a bad thing. Because I talked before about the dollar hegemony has a cost to it. We overvalue our currency, and to maintain that status, we basically hollow out our industrial base. We run these big trade deficits with the rest of the world to get them dollars, because in order to use the dollar as a global reserve currency, they need dollars. And ironically, they get them through our trade deficits. So I think that
Hmm.
as we enter a more multipolar world, either because neutral reserve assets are more popular or because there's some degree of diffusion among the top five or so currencies, that actually takes some of the imbalance away from the US economy. And going back to my earlier point, if that's kind of acknowledged to be happening, there are ways to kind of make that transition more graceful than if they try to fight back and fully maintain hegemony, even when it's no longer even serving our interests anymore. So I think that's kind of the big risk there.
Bitcoin rewrites the rules. It's not just money and not just an asset, it's capital you can carry anywhere at the speed of information. Unlike gold, it isn't bound by weight. Unlike fiat, it can't be printed without limit. Its scarcity is fixed, its network open, and its ledger transparent to all. Though still tiny in the scale of global wealth, its purpose is unmistakable. The first universal protocol for value, engineered to endure cycles and reshape how money moves across borders.
It balances the economy a little bit more. Basically, the US has a lower share of manufacturing relative to GDP than many other countries, because that's the part that we've kind of exported. And if you didn't have this capital recycling structure at the scale that we currently have it at, some of that would be able to flow back in. Now, realistically, a lot of that would be automated, but basically you have a more balanced economy at that point, and you're kind of less extracting it from certain states and then kind of reinvesting it into other states. There's also a really big wealth effect that happens. That basically that the higher our asset prices go, it kind of fuels consumption from those with assets at kind of the cost of those who don't. So we have these kind of really big mechanisms in place, and some of them seem good on the surface, but then there are losers from them. I mean, even for example, the home buying. A lot of times you'll hear about BlackRock buying homes, for example,
Mm.
but a lot of the funds, so that's kind of the one example, but there's a lot of funds and pools of capital buying homes, and some of that is actually foreign capital. Because in addition to buying our equities and buying our private equity, they're also, in many cases, buying our property. So basically, you inflate the property values at the cost of people that want to enter them. So we have this kind of unusual current cycle where home turnover is very low right now, so there's relatively few sellers, relatively few buyers. There's not a lot of activity happening, and yet prices is still pretty elevated because there's that kind of persistent bid there, and that's kind of it benefits those who have houses, obviously, but it's harmful for those who want to get them, and so that's why we end up having one of the highest historical ages for first time buying a home. Because there is still some buying, and a lot of those are able to do cash buys. So right now, the limiter to a lot of changing of home ownership is the fact that the mortgage rates, someone would have to get out of a low interest rate mortgage. They would end up in a higher rate mortgage if they move. And then the buyer has less kind of financial firepower because their monthly payments are so high. But it doesn't really affect too much the cash buyers, those either because they're wealthy or because they're investment funds that are able to come in and just pay the cash value for the house, and therefore around the margins still keep those home values pretty high. In fiscal dominance, almost everything the central bank does is wrong. That's the problem, is that because if they hold interest rates high, so go back to kind of what we said earlier, the primary purpose of raising interest rates is to slow down bank lending. The problem is that the whole period of inflation we've had for the past 5 years was not caused by excessive bank lending. It was caused by those fiscal deficits. Originally, it was intentional stimulus, and now it's just kind of this background higher deficit. So the Fed, in some ways, has been trying to raise interest rates to slow down bank lending to offset the real problem, which is the federal deficits. But by doing so, because the debt's over 100% GDP, by keeping interest rates high, they're also actually keeping the deficit high because they're keeping federal rates high. And yet, if they cut interest rates while you have stocks at all-time highs, gold at all-time highs, Bitcoin at all-time highs, property values at all-time highs, then they're adding fuel to the fire too. And that's why you get to that statistic where 98% of economies, when they reach these debt levels, tend to have some sort of default, which can be through purchasing power, because their own central bank kind of runs out of options. And so I think that it's probably due for a mild cut, just based on the deterioration of economic conditions. But I view that as a smaller lever to pull than the fiscal situation. Kind of one way of putting it is that when the money's weak, people will monetize other things. And then by doing so, they make those things less available to those who just want to hold them for their actual utility use, not their monetary use. And so by monetizing our equity market, by monetizing our real estate market, because our money's weak, it causes all these more structural imbalances, and therefore it causes periods of malinvestment, and it causes that kind of, along with other policy decisions, those high levels of wealth concentration. I think because the optics are so bad, like a key part of central banking is that they're supposed to have some degree of kind of optical independence, which is that they're focusing on their mandates, employment levels, inflation, things like that, and they're not really supposed to take into account the fiscal situation of the country. And yet, in practice, of course, you find that they, when the rubber meets the road, they do. So when there's a war, when there's a fiscal crisis, the central bank's options shrink, because at the end of the day, they have to kind of support that bond market. And so we saw this, in recent years. And basically, from their perspective, they can't say out loud that because the debt's a problem, that we have to kind of change how we would otherwise do things. And I think actually, like that, going back to my prior point where I would say it's hard to criticize the head of the central bank, even though I'm kind of critical of the whole practice of central banking. The one thing I think that it's fair to be critical of is the asymmetric talking point they've had around the fiscal deficit. So, for example, during COVID, during the depths of it, the head of the Fed called for more fiscal. He basically said, our tools are limited here, given what's happening. We need more fiscal spending. And they got that. There was, of course, very large stimulus efforts. And now on the other side of that, they won't go out and say that the opposite. They won't say that our ability to control inflation and kind of tweak all this is being hampered by the fiscal side. That basically our tools are not geared to doing that, and if anything, could make it worse. So they have to kind of show confidence and say, look, we got this. Our tools can fix this. But the problem is that I think it doesn't. That basically that their tools are largely unrelated to what the core issue is, and I think that the first step is basically to say that, and they're not doing that part. Yeah, I think that's what he has been trying to do, which is by holding interest rates high, it makes the dollar fairly strong compared to other currencies. It kind of puts pressure on the rest of the world. It does keep commodity prices in check. For example, oil, generally speaking, it's hard to have out of control inflation if oil prices are pretty low, which they are. So it's having those effects. But then the problem is it's grinding out more and more of this public debt, which is actually ironically spewing more dollars into the market. The problem is that in kind of no world, if there was like an acute bond crisis, would they kind of blink and just let it happen? Because one of their kind of shadow mandates is financial stability, and that goes at the heart of financial stability. A really good example is the Bank of England, which was under similar strain. So back in 2022, inflation there was like 10%. The Bank of England was going to do a speech around balance sheet reduction, so quantitative tightening. And then the gilt crisis happened. So for people that aren't familiar, the UK's sovereign bond market kind of broke. It was just kind of this leveraged, vicious cycle. So yields were rapidly rising, causing more entities to sell. And ironically, the Bank of England had to cancel their speech on balance sheet reduction, and they had to go and buy the bonds, despite the fact that inflation was 10%. So
Oh,
they did something that is normally only done in a low inflation environment, and they basically had to do it out of an emergency to maintain kind of just functioning like sovereign bond markets because everything would have kind of ground to a halt. And I think we would see the similar thing in the U.S. that basically they can try to pretend as though that by increasing interest rates that they would maybe change the fiscal trajectory of the country. But I think in practice, the problem is that the fiscal side would pretty much just ignore them, as they have recently. For example, the big beautiful bill doesn't really have deficit reduction as part of it. The only thing that it kind of some ways is deficit reduction is the tariffs. But basically, there's been kind of no change during that process. And if they actually were to get called out on it with some sort of bond issue, I think we'd see the Fed pretty much right in there. We also saw this back during the 2023 regional bank crisis. So inflation was still above target back then, even more than it is now. And if they let banks fail, that does destroy part of the money supply. But they were more worried about the cascading perceptions of bank instability. So they actually went to a period of temporarily balance sheet increases and liquidity provision to put out that fire, despite the fact that inflation was above target. So generally speaking, whenever they actually run into a true crisis, they do generally err toward allowing that inflation, keeping things nominally together, and then trying to slow things down in the future.
Bitcoin now holds firm above $114,000, fueled by ETF inflows and institutional balance sheets, not just retail hype. With daily flows surpassing $750 million, it's being treated less like a gamble and more like a reserve. Ethereum rides the wave with spot ETF demand, while XRP's $3 resilience shows retail conviction. The bigger story echoes Lyn Alden's point. The divide between assets traded for speculation and those trusted for preservation. Altcoins may serve niches, but Bitcoin's role as a treasury asset is solidifying. As liquidity expands and the Fed eyes cuts its path toward $120,000 looks less like a rally and more like the quiet establishment of a new monetary standard.